players. If you're on a replay, you can tap the screen for hearts. And today we are going to be talking about investing. So, welcome if you're new to my broadcast. My name is joannazarach, and I broadcast, first of all, every day at 10 a.m. Central Time, Chicago time, on money habits. And I am broadcasting twice a week on Money Matters, where I talk about the basics of finance, and I cover a topic in depth for about a half hour. So the format is, I mostly, today is Investing 101, and I really mean in its very basic definitions. I think that a lot of people aren't really sure what investing is, or the stock market, or bonds, and they're confused, and I think that there isn't a ton of, they either get overwhelmed with information, they go to people for information that they're not really, their specialty is not really education, it's selling financial vehicles. And so I think it's really hard to sometimes just say like, well, break it down for me, right? So in today's broadcast, what I'm going to be doing is just talking about investment basics and just breaking it down. So I do encourage people to ask questions. I do know I talk fast, so if you feel like you're interrupting me, it's okay. I can take the interruption. So ask me questions. If you're replaying, or if you didn't have a chance to ask your question, you can follow me on Twitter, same exact username, and ask a question on Twitter. I would love for nothing else, for nothing more, but to answer questions about personal finance. So, okay, this might be a little bit more sturdy. So Investing 101, and what I really want to cover today is just some basics. One is why investing matters, to talk to you about, why you should care, to talk about what's a stock, what's a share, what's a bond, like how are they different, and talk a little bit about mutual funds. And again, why you should care. So what's an investment? When we talk about investing, what do we talk about? And I'm not going to talk about the philosophical, like investing your time or your emotion. I'm really talking about capital assets. So what's an investment? An investment is basically putting your capital, which refers to money, at risk with an expectation of a positive return. So once again, you're going to put money into an enterprise of sorts, or into some sort of vehicle, and you're going to expect a return, which means you're going to expect to get the principal, to maintain the principal and get additional capital, additional money, right? So what does it mean to put something at risk? Risk means that there is no guarantee. So first of all, there's no guarantee of return. So you can't just say, oh, this is how much money you're going to get back. There's usually an estimate. And we know the higher the risk, the higher the likelihood of not only not knowing what the return is, but also of losing your principal. And I think those two things, the lack of certainty about the return, but also the possibility of losing principal, is what makes people scared about investing in the first place. So let's talk about this a little bit, because a loss aversion, or the emotion that you have when you lose money, even when there is an upside that's greater than the initial loss, or loss at any point in time, is actually, it makes people feel worse. And so people will avoid losses, potential losses, because there is that like emotional thing of loss aversion. So be aware of that. And this is why, we talk about investing, and we'll talk about why it's so important to be an investor, even though there is risk, there is, there's some likelihood of losing a principal, and everyone will have a nightmare story of how they lost money in investment, right? They'll probably talk about that more if you ask about investing. If you ask someone else about investing, they will tell you more about the losses. Why? Because it's an emotionally difficult thing. So guarantees, right? Everyone wants a guarantee. And by the way, there are people who will sell you guarantees, and the guarantee is just a desire to be 100% protected from loss in absolute terms, even though your purchasing power may go down, right? So we're going to talk a little about purchasing power. We're also going to talk a little about value. What does value mean, right? So value is what you can receive in an exchange, right? It's not absolute or intrinsic, yet we expect the value of things we own to go up and the value of the things we want to go down. So it's just an important aside. But we're going to talk about value and valuing and investment, just the whole idea and concept of money and currency. And I think that, again, I'm trying to encourage people to kind of figure out what they know about investing, make sure they understand what an investment is, and to encourage them to get into investing, because whether you know it or not, you're already an investor. And by that, I mean, participate in a 401k plan, if you have an IRA, if your parents have one, right? So your family in some way or form is probably investing. You may just not be educated about it. So why is it important? We talk about value and we talked about purchasing power, right? And so if you're at all a follower of Warren Buffett, which, as any money nerd, you got to love Warren Buffett. Why? Because he's been around for so long. He's kind of seen it all. And he's really been very thoughtful about it, and he's executed on his ideas. But with the recommendations he makes, it's just very sound, right? That's why I talk about, I'm a Warren Buffett kind of investor. I just am in it for the long term. And one of the things that he talks about is sort of the value and purchasing power and inflation. These are things that people don't sit around thinking about, but those are real things, right? So again, what is value? Value is the exchange of goods or services for a set amount of currency, right? Because that's at the end of the day, when you talk about money, it's just currency, it's just net worth. It's a bunch of numbers, right? To me, that's why I really love it, because it's a bunch of numbers. You only capture value when a transaction is completed, right? So whether you're exchanging services or goods, whether you're the purchaser, you're the buyer or the seller, that's when value is realized. And so basically, when you're investing and why you invest, because the question you're ultimately trying to answer is, what is your asset's ability to create future purchasing power? I know that's a mouthful, and it's but something I want you to sing it. What is your asset's ability? And by the way, most people's number one income generating asset is themselves. That's what you're doing, is you're an asset that's selling services and you're creating future purchasing power. And the future may be near term, it may be to your next paycheck. But that's what we're trying to protect against, diversify against, is to create another asset that is generating future purchasing power. That's what investing is all about. So different types of assets, real assets, right? And real assets are not just real estate. It's just anything you would tangibly have that you own that can be of use to someone in exchange for money. And obviously paper assets, which we're going to talk a little bit more about, is the stocks and bonds that can be converted to monetary value to purchase what you need, which are goods and services. Because stocks and bonds are not intrinsically of value to the humanity. They're not gonna save lives or feed people. So, and the reason we talk about this, because there's this thing that's been happening over time. It's inflation, right? We talk about it, and it's funny because I think of our own experience, including my own, in the U.S., inflation is this gradual increase. Or what we think as gradual of costs or prices of the goods and services that you'll need access to in the future. And so inflation is a really important concept to understand and think about and think through, and also appreciate that this gradual period that we've had, that's not always the case for the U.S. It's not always the case for other parts of the world. So that's why where you keep your money and where you keep your assets can determine sort of your future purchasing power. And what does inflation really mean when you break it down? It's basically that $100 today will buy you more goods and services than $100 will, for example, if you go out in 10 years, right, or in 5 years. So if you keep your money just in fixed currency, it'll buy you less stuff in the future, right? If you just really want to break it down. Some exceptions apply. Some things that go down in price, go down in cost, but mostly, we see inflation. Okay, so now that we've covered some of the why invest and what's the value, let me just cover the three concepts that I want to talk about today. It's the stocks. What are stocks or share? I don't know, is known as shares. What are bonds and what are mutual funds? So all a stock is partial ownership of a corporation, and for this purpose, it's of a publicly traded company. So what we talk about when we talk about the stock market in the U.S. It is the things you can buy and sell on the stock exchange are shares or partial ownership of publicly traded companies. And what does it mean to be public? So in the US, the Securities and Exchange Commission, specific regulations about what it entails for a company to be able to be publicly traded, which means it's open to just anybody. There's a ton, by the way, there's a ton of privately owned companies in the US. That's how most people generate wealth, by the way. And we're not going to cover that. That's maybe for another time. That's like Money Matters 202, not 101. Why do companies go public? You know, they're big enough, they want to reach a capital market, offer a big pool of money, blah, 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 blah. There's more capital that's made available to those companies. And also the founders want to cash out, or the investors, really. There's lots of public regulations, financial protection of the investors, and all that. The thing that's relevant is, how does one make money from a stock? And I think that that's sometimes not well understood, that there are two ways in which a person makes money, like how it converts to currency that's in your favor. So there's the purchase of a stock. There's two events that happen with a stock. Well, actually three. So the events that we think of is buying of a stock and selling of a stock, right? That's you have to buy it, you have to put out currency to own some shares, and then you need to sell it. And the difference between it, right, if you buy low and sell high, which what everybody wishes they had, then you would collect that difference, right? If you bought a stock at 10 and it went up to $20 and you sold it, you're like, hey, that's 10 extra dollars. And that's what capital gains is, to get a little more technical, because we talk about it when we talk about taxation. And that's capital gains. That's and long-term capital gains is over a year. But that's one way in which you make money off of a stock. And thank you for the hearts. Is when you're buying it and selling it, and the difference between those two numbers, if it's positive, is a gain. Now, what happens is sometimes you buy a stock and it goes down in quote-unquote value, which means its price goes down. And when you want money and you are forced to sell it, you're going to collect some money, but it's going to be less than what you initially put up. So that's a loss. And that is one of the things that really scares people, is the potential for your stock to lose value, which is for its price point to go down when you have to sell. So that's one way. And by the way, those are typically when people talk about growth stocks, they're expecting stocks to grow in price. So that's one way to do it. The other one is sort of the more, I think about it as the original way, right? It's just the dividend, right? And dividend, I don't know why it became so unpopular. I think it's all it all started with the internet bubble in the 90s. But all dividend is distribution of profits to shareholders. So your share of the profits that you get, that the company management makes a decision of how much of the profits to return to the shareholders at the end of each year. So say if you have 100 shareholders, and the company profits and makes a dividend of 1,000, each shareholder gets $10 for their share. So if you have all the shares, or if you have half the shares, you get proportionally the amount of dividends. So that's something that's paid out to you. And we all know about dividend reinvestment, where basically some plans have a dividend reinvestment. That all it means that when that company generates a profit, you immediately go and buy more of that company's stock, or you can keep it as cash. Dividends are taxed at your income rate, so those are a little bit less favorable in certain situations. And sometimes those are referred as value stocks, right? So if you see growth versus value, growth is typically expectations of price of your stock to go up in value, and then dividends are the value because they're just generating value to you. Anyway, that's me trying to simplify it. So that's the stocks. That's what the stocks is, just ownership of all of these companies, all these big corporations. And when you research, you go in a ticker, and that's when people get really excited when it comes to investing, like, oh, I'm investing in a stock. I tend to not invest in stocks. Why? Because, that it's complicated. It's complicated to make those bets, and it's hard to make those bets. It's it's betting, right? It's betting on the future of one company. Before I get into mutual fund, because that's going to be the next, what do I do and how do you diversify your risk? Let's talk about bonds. People's like, oh, stocks and bonds, right? Those are the typical two words people throw around when it comes to investing in the market. What are bonds? In the simplest terms, to me, bonds are like IOUs. It's borrowed money, right? So companies will borrow money from the market, right? And there's a determination to figure out like how trustworthy are these companies. They're corporate loans basically, and they're made in an expectation that corporation will repay those loans because, you know, they plan is to invest the money to bring a higher return for the corporation profit. But the bonds have like a fixed, you know, they have a set interest rate. You're like, I'm going to borrow this much at this rate, and you as the bondholder are entitled to a return. So those bonds can be, you know, bought and sold too, right? And based on what expected cash flow of the repayment plan would be. So that's why bonds are seen as a safer investment, because it's fixed, right? It's a loan. And there's also a lot of evaluation that goes into, you know, the crediting company. There are companies that sort of evaluate credit worthiness of a corporation. So they are, you know, they're measuring risk. There's like a corporate credit score basically. And based on their credit score, you'll get a different rate. So if you're lending out money to a corporation with a really good credit score with a high likelihood of repayment, you're not going to get a huge interest rate, right? And again, it depends on the interest rate environment, which we all know, as if you've had a savings or checking account for the last 10 years, you know it's not generating a lot of interest, right? Our interest rates have been low for a very, very long time. That hasn't always been the case. And so that's why you really need to learn about a variety of investment vehicles, because the world is a changing place, right? So I have some bonds. I invest in bond index funds. Like I don't invest a single bond. I just do the same thing as I do with a mutual fund. I'm like, oh, you know, there's a bond index. I'm just diversifying my investments. So I do that. It's just a bouquet of bonds. So let's get to my favorite investment vehicle, which is mutual funds. What's a mutual fund? A mutual fund is just a collection of stocks held in a fund that you can own instead of like trying to pick it your own. It's kind of like fractional ownership, right? So a manager, you know, someone will go and they'll decide what goes into a mutual fund. Someone selects the stocks, and so there's actively managed managed funds and sort of more index or passively managed or less managed, really. So actively managed mutual fund might be a fund where someone well paid and well versed is making sort of bets, and they're buying and selling. So maybe they're trying to make that capital gain, and it might be a short-term capital gain, or they're rebalancing that portfolio, or they're going after the hot stock. Maybe they're trying to get in the IPO. So they're trying to be clever about, about like how to generate a better return for you, and you're going to pay more money for that. Somebody actively managed fund is usually someone selling you on the idea that they are much smarter than you are and the market. So they're going to pick those bouquet of stocks, and they diversify. So on the other sort of the opposite part, or the other part of the spectrum, is an index fund, and there's like they're index funds that are just pure like S&P index, which means they follow or track that. They use like whole market funds. There's Dow. There are industry-specific index funds, and they just basically mean that there's some set of quote-unquote rules. I don't know if somebody writes those rules or, but they basically hold a set of stocks, and they don't really do as much trading, and so they may be readjusting. There might be some strategy, but they're usually, an index fund will just follow the S&P, like whatever's in the S&P 500. So they'll just have shares of all those companies in it, and there's just not a ton of, or not as much activity. So they are lower cost. That's why, if you, again, bring our friend Warren Buffett in, his thing is, if you're just your average investor, your best bet is to put your money in a low-cost index fund, and just, over time, it'll grow at the lowest fees, which means you'll get to keep more of the money for yourself. And that's really the big thing that I always emphasize is you got to figure out, the market as it's known. It goes up and down. There's not a lot you can impact, not a lot you can control. And there's a lot of research that's been done. And by now, if you're not familiar with it, the statistics show that like 96% of actively managed funds do not beat the return of the market or index funds. And so basically someone may be collecting additional fees because they promised you that they could beat the market, but most of those promises don't come through. And you just paid more for the privilege of doing just the same as everybody else. I don't know what mild means. And so, so then that's so my, you know, what do? I like mutual funds, and I know that now there's more advanced exchange traded funds, and I know one of my goals for this year is to get away from just mutual funds, because that's kind of what I grew up with and what I'm comfortable with, and just explore exchange traded funds, which are similar, but you can get you can buy into them during, you know, like you can get a price that's more real life market versus end of the day price. So most mutual funds, like, you buy at whatever the value is at the end of the day of that mutual fund, and the same thing with selling it. So that's all a mutual fund is, and it's an easy way for you, for an average investor, just diversify, right? Because you buy a share, you know, you put money in a mutual fund, and it's basically a basket of funds. One of the interesting things that you can do is actually, when you're researching a mutual fund, now it's a lot easier to research nowadays, right? Because you can just go online, look at the prospectus, you can actually see what they're made up of, like what's their top 10 holding and what percentage are. All right, it's funny things that, like, the big corporations, like every mutual fund out there, and I know that's not 100%, but Apple, like, is in every mutual fund, right? Like Google, like all of these big name companies that we recognize, you know, it's IBM or GE, whatever it is. Like, there's, you know, sometimes we think we're more diversified than we really are, because the, you know, wealth is concentrated. So if you want to diversify, you may want to look into like a small cap index fund or mid cap index fund, because they'll typically have companies that are outside of just like the run of the mill, the top 5 or 10. So you may want to look into that. So I encourage everyone to become an investor, and what I mean by that is to learn about investing, to take the time. And again, you know, you can take you just do a little bit of research, start following the market. Like, I started, you know, I was an investor, like, you know, I had a 401k, I had an IRA since 98. And I didn't really follow the stock market, right? Like, I maybe read some business news here and there, and I've really only gotten into a habit where I open my tabs and I talk about like what's important, you know, my Wunderlist, my Mint account, you know, I do some lending club, Yahoo Finance. That's kind of the only reason I do Yahoo Finance, because like right on the front page, they just have those like tickers. I wanted something really simple, so I just go in Yahoo Finance. I'm on there every day, just to check, like, how's it going? How is the market doing? It doesn't ruin my day if it's down. I don't cheer, you know, when it's up. I just, like, I'm in mutual funds, and I go, okay, I'm in it for the long term. But I encourage everybody to start paying attention. So it's not to like bring some, because if you don't look at it, you know, it's still going to be the same. Like, the numbers are going to be what the numbers are. But I want everyone to start paying attention to it. Because if you do want to, and as you know, my spiel, if you're on a path to financial freedom, or you want to be on a path of financial freedom, eventually you will be an investor. If you have a retirement plan, if you hope to retire with some money, you will be an investor. Now, whether you're a conscious investor or if you're just completely, you know, giving your money over to someone else, it's a different story. But if you just spend a little bit of time every week on teaching yourself, educating yourself, just a little bit, you know, like, just pick one thing and say, I'm going to learn a little bit about this, you know, I want to learn a little bit about more stocks, or specific stocks, bonds, holding, fees. Figure out, the other thing I ask people to do is, if you do have that, like 401k plan, and you've just you're like rolled it over, and maybe it's sitting there, or or it's in your employer, find out where your money is. Like, figure it out. Like, what are the actual holdings? And, you know, figure out what the login is. Like, figure out how to do that. And now with more and more, and you'll see more in the next year or year to 5, whatever, fintech is the most popular thing in technology, right? You'll see more and more tools that are available to you that'll help you analyze that thing. So I know Future Advisor sold out. I think that there are some tools, and I need to start using some of those to just really break it down. Like, I use Mint just to look at my, like, the account value. Terrible to try to analyze your investments. But really take the time, make the time, not just take it, make the time to figure out where your money is, sort of what funds it's in, what the costs are. And I know that's tricky, by the way, because the fund costs are obscured for a reason. Yes, I said that. The funds costs are obscured for a reason because there's a lot of money being made managing your money. So I want you to take control and be more curious about where your money is, and if you and just learn a little bit over time. Like, I didn't get here, I'm not a financial professional. I'm a financial enthusiast, and my enthusiasm for it has gotten me to learn over time. So I encourage you to aim to become an investor, because you'll just be either conscious or sort of an unconscious investor. It sounds bad, but you want to know where your money is, where it's going to go, and you want to have a plan for it, and you want to basically, what you're trying to do is guarantee yourself purchasing power in the future for goods and services that you'll need to live a comfortable life and to provide for yourself, your children, or any other loved ones that you may have, or to leave a legacy, or whatever it is you want to do. And investing is, it's the American way. It has to become the American way, because like the death of pensions, it's become part of what we need to do. Like, you read, and you have to learn to read, right? You have to learn the internet, right? Like World Wide Web, Facebook, Instagram, whatever social media tools you have learned, you've got to learn investing as well. So that's it for today. Do you have any questions? I know I just talk. I never make chance for questions. If you have any questions, ask here, ask on Twitter. There's nothing more in life that brings me joy than talking personal finance and teaching someone anything I know about money and managing money and what I've learned. And it really does. It makes my heart sing to teach money. So thank you for joining, everyone. You stayed on the entire time. I salute you. I am keeping these to a half hour, and I'm quite proud of myself with like my cadence of information. So if you tune in for, I think next week I'm going to cover, yeah, go ahead. Yeah, I'm always welcome to feedback. What's a recommendation? Yeah, next week will be college savings plans, as I'm waiting for my recommendation comment. College savings plans, 529 plans, all that stuff. How do you save for college? And then I think, so I'm trying to do 2 a week. I don't know if I'm going to get a second one in next week, because it's a short week with holidays and a day off on Friday. So I might just do 1. Oh, well, you know what? You're right. I don't do that enough. I have in my I try to make my little Periscope script where I'm like, ask for a share, and I don't. But I appreciate you, and I hope the content was helpful. And you're right. I should just say, if you're finding this content helpful, to share. Thank you. Yeah. I'm trying. I'm still learning, and I follow a lot of Periscope gurus, and I watch their stuff, and I'm like, oh, this guy's really good. This gal's really good at this. But thank you for the feedback. I do appreciate it, and I'll do that, and do that up front. That's also good feedback. I will do that. You know what? Next, thank you. Next, Money Matters, I'm going to do one on Tuesday. It's going to be on college savings, specifically 529 plans, but also any other college savings and kind of the trade-offs between college savings and retirement, or college loans, college payments, all that stuff. And then I think so next week I'll probably just do one Money Matters. Again, I love Alex. I love Alex Khan. He's great. He is fantastic. He is fabulous. I do watch him. And I will do in 2 weeks. In 2 weeks, I'm going to talk about business ownership and personal finance, because I'm a business owner, and I want to share some of that information of how you need to change, how you really need to take even more control of finance if you're going to become a business owner. But that's going to be in a couple weeks. So next week, college savings plans. And again, I'm on here every single day, 10 a.m. Central Time. I talk about money habits, because that's really how you're going to make a difference in your financial situation if you do things regularly and if you do things habitually, if you develop a good habit around money. So again, thank you for the feedback. I appreciate it. I'm going to follow through on it on the next broadcast. Because if you're on here tomorrow, I'll be on here tomorrow, 10 a.m. Because it's 7 days a week. By the way, I'm committed. I think I'm like on 85 days in a row that I've been on every day at 10 a.m. So I'm committed to you because this is important, and I do want to help everybody develop better money habits. And I want to teach you anything I will know. I want to break it down, answer it. There's no bad questions. And thank you for the hearts. So thank you again for joining me. And again, if you're not following me and you do want the replays, you know how to follow. Click on my name, slide something, click on my name, click follow. And I'll see you tomorrow or some other time.